the word recession. It's a word that can cause a lot of anxiety. It brings to mind job losses, struggling businesses, and a general feeling of economic gloom. But what if you could see it coming? What if there were signals, like tremors before an earthquake, that could warn us when the ground beneath our economy is starting to shake? Welcome to G Fun Facts Online. Today, we're becoming economic detectives. We're not looking into a crystal ball, we're looking at data. We're going to uncover the secret signals, the economic seismographs, that have historically warned of an impending recession. And by the end, you'll understand how economists and investors try to read the future. Let's start with the most famous, most reliable, and frankly, the weirdest predictor of them all, the inverted yield curve. This one sounds complicated, but the core idea is simple. Imagine you're lending money. If you lend a friend $20 until next Friday, you're taking a small risk. If you lend them $20 for the next 10 years, you're taking on much more risk and uncertainty. You'd naturally demand a higher interest rate for the 10-year loan to compensate you. This is how government bonds, which are basically just loans to the government, are supposed to work. A 10-year government bond almost always pays a higher interest rate, or yield, than a short-term 2-year bond. This is a normal, healthy sign. It's called a normal yield curve. But sometimes, something strange happens. The curve inverts. The short-term 2-year bond starts paying a higher interest rate than the long-term 10-year bond. This is deeply unnatural, and it is a massive red flag. So why on earth would it happen? It's a global vote of no confidence in the near-term economy. Big institutional investors, the ones managing pension funds and trillions of dollars, start to believe the economy is heading for trouble. They anticipate that to fight the coming slowdown, the central bank, like the Federal Reserve in the US, will have to dramatically cut interest rates in the near future. So what do? They rush to buy long-term 10-year bonds to lock in today's relatively higher interest rates for as long as possible. This massive wave of buying pushes the price of 10-year bonds up, and just like a seesaw, when the price goes up, the yield or interest rate goes down. It gets pushed down so far that it eventually drops below the short-term 2-year yield. It is the financial market screaming, "Batten down the hatches, a storm is coming." Historically, an inversion of this 10-year/2-year spread has preceded every single U.S. recession since the 1970s, typically with a lead time of about 6 to 24 months. While it's not a guarantee, it's the closest thing we have to an economic oracle. Now let's move from the abstract world of bonds to something much more personal: jobs. The health of the labor market is the pulse of the economy. A strong, beating heart. When that pulse weakens, the whole body is in trouble. The first place we can check this pulse is a weekly number called initial jobless claims. This is simply a direct count of how many people in the U.S. filed for unemployment benefits for the very first time that week. Think of it as the economy's early warning system for job losses. If one factory closes, the number ticks up in a specific region. But when that number starts consistently rising across the country, maybe by 20 or 25% from its recent low, it's a sign that layoffs are no longer isolated incidents. It's a trend. It's the first tremor of a weakening job market. But there's an even clearer signal, a simple but powerful rule developed by economist Claudia Sahm. It's called, appropriately, the Sahm Rule. It is brilliant in its simplicity and is designed to spot a recession in real time, not months later. Here's how it works. First, you find the lowest the national unemployment rate has been over the past 12 months. Let's say that low point was 3.5%. Then, you calculate the average unemployment rate over the most recent 3 months. If that 3-month average rises by half a percentage point or more above that low point, so in our example, if it hits 4.0%, the Sahm Rule alarm bell starts ringing. It signals that a recession is either already underway or is beginning right now. The logic is a powerful feedback loop. Significant job losses mean thousands of people suddenly have less money to spend. Since consumer spending makes up about 70% of the entire US economy, this is like slamming the brakes on. When people stop spending, businesses sell less. When businesses sell less, they don't need as many workers, which leads to more layoffs. This creates a vicious cycle that the Sahm Rule is designed to spot right at its inception. This brings us perfectly to our next indicator, the mood of the consumer. The labor market tells us about people's ability to spend, but consumer confidence gauges their willingness to spend. Even people with secure jobs can get spooked. Organizations like the Conference Board and the University of Michigan conduct huge monthly surveys. They ask thousands of households questions like, "Do you think your family will be better or worse off financially in a year?" And, "Do you think now is a good or bad time to make a major household purchase, like a home or a car?" When the answers to these questions turn sharply negative, consumer confidence is falling. This is a critical forward-looking indicator. Scared consumers change their behavior immediately. They decide to put off renovating the kitchen. They cancel the family vacation. They make their old car last another year. This pullback on discretionary spending, the non-essential wants, is a direct hit to the economy. It's the canary in the coal mine. If consumers get worried and stop buying things they don't absolutely need, businesses see their sales forecasts evaporate, which leads them to do what? Cut back on production. And that takes us to our next signal, the view from the factory floor. The most watched indicator here is the Purchasing Managers' Index, or PMI. This isn't a government statistic or an academic theory. It's a real-world, ground-level survey. Every month, the Institute for Supply Management asks hundreds of supply chain managers at companies across the country a simple question: are things getting better or worse? They are asked about new orders from customers, their own production levels, employment at their factories, and how quickly their suppliers are delivering materials. The answers are compiled into a single index number. The magic number is 50. A PMI reading above 50 means the manufacturing sector is expanding. A reading below 50 means it's contracting, it's shrinking. A sustained period with the PMI below 50, especially if it dips towards 45, is a classic recession warning. Imagine you're a purchasing manager for a company that makes furniture. Last month, business was booming, and you were ordering tons of wood, fabric, and steel. This month, your boss comes to you and says, "Hold on, sales are dropping off a cliff. Cut all new orders by 30%. Now, imagine hundreds of purchasing managers at thousands of companies all getting that same memo at the same time. That is exactly what a sub-50 PMI reading is telling you. It's a direct reflection of that drop in consumer demand we just talked about. It's the bullwhip effect in action. Next up, what about the flashy, headline-grabbing stock market? The stock market is often described as a forward-looking mechanism. Investors are constantly betting on what they think corporate earnings and the economy will look like in 6 to 12 months. A bear market, which is officially defined as a 20% or more drop in major indices like the S&P 500 from their recent peak, often precedes a recession. As investors grow pessimistic about the future, they sell stocks, driving prices down. But the stock market can also be volatile and emotional. It can be a bit of a drama queen, reacting to rumors and short-term news. So while it's a useful signal, it has also given false alarms. That's why many economists prefer to look at broader financial conditions. One of the best measures for this is the Chicago Fed's National Financial Conditions Index, or NFCI. This is a super index. It combines 105 different measures of risk, credit, and leverage in the financial system into a single weekly number. Think of it as a blood pressure reading for the entire financial system. It looks at everything from corporate bond spreads to bank lending standards. When this index is negative, conditions are loose. Money is easy to get. When the index turns positive, it means conditions are tightening. It's getting harder and more expensive for businesses to get loans and for consumers to get mortgages. When credit, the lifeblood of the economy, dries up, economic activity slows dramatically. Tighter financial conditions have historically been a very strong companion to recessions. As you can see, no single signal is a silver bullet. The yield curve is powerful but has a long and variable lag. The job market is crucial but can turn late. The stock market can be a false alarm. This is why the pros look for a chorus of warning bells, not a single note. This leads us to composite indicators. The most famous is the Conference Board's Leading Economic Index, or LEI. This is the ultimate economic mashup. It takes 10 of the best predictive indicators and blends them into one comprehensive figure. It includes things like the average hours worked in manufacturing, initial jobless claims, new orders for goods, building permits for new houses, consumer expectations, and yes, the yield curve spread. The logic is the same as the dashboard in your car. If one little light flickers on, you might check it out later. But if the check engine light, the oil pressure light, and the brake warning all come on at once, you pull over immediately. A persistent, sustained decline in the LEI is that master alarm. It's telling you that multiple independent parts of the economy are all flashing red at the same time, making the signal of an impending downturn far more reliable. Before we conclude, let's do a lightning round of a few other important seismographs. The housing market. A slowdown in new home construction and a drop in prices is a classic warning sign, as the sector is highly sensitive to interest rates. Corporate profits. When companies start making less money, they have less to invest in new projects and hiring. The price of gold. During times of uncertainty and fear, investors often flee to gold as a safe haven asset, driving its price up. A spiking gold price is often a measure of rising economic anxiety. And finally, there's gross domestic product, or GDP. This is the official measure of economic output. A recession is often defined by the media as 2 consecutive quarters of negative GDP growth. But GDP data is released with a significant delay. It tells you what happened months ago. It confirms a recession. It doesn't predict one. It's like getting a formal letter in the mail telling you that your house was on fire 3 months ago. Useful for the history books, but not for grabbing a fire extinguisher. So how do we put this all together? Predicting a recession is not an exact science. It's an art that involves interpreting a complex symphony of data. It's much like a doctor making a diagnosis. A cough alone might just be an allergy. A fever alone might mean you just overdid it at the gym. But a cough, a high fever, body aches and fatigue all appearing together? That paints a much clearer picture of the flu. In the same way, an inverted yield curve on its own is a serious warning. But when it's combined with steadily rising jobless claims, falling consumer confidence, a contracting manufacturing sector, and tightening financial conditions, that is a chorus of warning bells that is historically very difficult to ignore. The goal of understanding these economic seismographs isn't to predict doom and gloom with perfect accuracy. It's to understand the powerful forces at play beneath the surface of our economy. This knowledge is not meant to create panic, but to foster preparedness. For governments, it can inform policy. For businesses, it can guide strategy. And for individuals, it can help inform our own financial decisions, like focusing on an emergency fund or reevaluating investment risk. In economics, as in life, knowledge is power. Thank you for tuning in to G Fun Facts Online.